Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So the agenda today, we'll do the market update. I'll review the outstanding trades out there for earnings, and then Joe's got some analysis charts to go through. So let's get at it. So overall market, pretty much the same, bunch of eights. Across the board. Joe and I were talking the other day, pretty much the only safe haven so far has been like this dollar index. It's UUP, DXY, and is the indice. That one's pretty much been best performing, I would think. Oil's up there too, holding value, but everything else is pretty much taking it on the chin. So, we'll get into the individual ones there. From last week, 11, now we're at 17, so not a big jump. Still pretty much flatlined across everything except for state 8. So let's take a look at the market pulse here. State 1s versus 8s. We peaked out right around 73, barely dropped, like 4% or something, and kind of leveled off here. So we'll have to see what, if we make a new high here, before we get decent drops and kind of flatline drops, things like that. This one's actually, gone up a little from the drop, so that's not encouraging, but we'll have to wait and see on that. This market's definitely been very difficult. I think we got the long-term trend nailed down, bearish. But, like finding these pops in the market, definitely difficult. Last week, we dropped down to pretty much nothing on new lows, but, since then, we're 672 as of yesterday. Was of course the new highs have just been flatlined for year to date. Nothing going on there really. So just kind of like the dwells and then the spikes. I'd say very bearish overall. We'll look at the bullish bearish percentage here. And I think Joe's gonna try and do some more analysis on these percentages and stuff in the future. But here we got up 90. I mean, ridiculous. Single digits in the bullish. Popped up a little and then kind of flatlined, just like state 1s and 8s. So, we'll have to see if we actually roll over. Before here we had to drop and then make new highs. But most of the time after that really high number, it'll kind of start dwindling down. But we'll have to wait and see. So I don't have a crystal ball for that, but overall things are obviously very bearish. So let's look at the SPX here. Back down to pretty much made new lows here yesterday. The low value actually was a new low. So we're pretty much you can see here the current move is pretty much the average move. So we're right around that typical turning point. If it does turn, not saying it's going to turn, but like big kind of picture wise, chart wise, that 3,800 has seen a lot of resistance over here. Tried to get back above that 3,800, failed, had a swift drop back down. So the low end of that range is 3,400. So really, what we want to watch here is going to be, the target 3, that's should provide pretty strong support for stocks down there in this range. But if we do break through, then all bets are off. So kind of the key levels here. Obviously, we're not really near that 3,800, but kind of short. We have other indices that are, give us a better upside, but, downside, this one's fairly close. So, I'd be watching this target 3, especially if it starts acting like support. If we get a few days kind of like, just messing around up and down, that's usually a pretty good sign. So just something to look for there on SPX. Let's pull up the overall chart here. Yeah, so not looking good. Made new lows here. So there's the June lows. Made new lows here, then made new lows here as of yesterday. So making new lows. We talk about that big downward trend. Just keep way far away from that. That's 4,200-ish. So really far away from that. Well below also our 250-day. So the 50 has been kind of 50-50 on whether it provides good resistance or not. You can see here it's kind of like a 50-50 choice here, but obviously something to look at. There's gonna be resistance usually in there. So downside, we got that, just call it 3,500 just to make it easy. Instead of 3,512, just call it 3,500, make a nice round number. But other than that, we got 3,800, and I can't get on. There we go. So 3,800s, current range. There's our 38, and then down here, it's going to be the bottom. So we're pretty much smack dab in there. In the
Hey,
middle.
Josh,
Yep, shoot.
is there an easy way for you to show past history of SPX and state 8 target 3? I'm curious to whether it bust through target 3 state 8.
Well, I guarantee it has, but I don't, we have a tool in the system, but it's not working properly, so I can't pull up those numbers right off. In the future when they fix that, we can pull that up, but you'd have to do it kind of manually, and it's very cumbersome to go back, to each state 8 and look. Obviously, if it's like, if it's like, like this, maybe, well, that one you could still even hit. I don't think it broke 3 there, but you'd have to do it manually.
I understand.
Yeah. But it looks like these, both of these have, basically broke, I would say this broke through 3, just based off of the total movement. So, but that'd be something interesting, and we can pull it up if you remind me. I don't want to mess up all the charts I pulled up, but when we're done here, I can pull up this last occurrence, see what happened.
I understand. Thanks.
Yeah. So that's SPX charts and all. Obviously, if we continue making lows, not a good thing. Russell, a little better state 8 here, but still, down in that kind of key resistance. This is kind of like the typical movement, but if we just kind of forget this part here, so it's kind of doing typical after this kind of craziness. So down would be 10%. So we're about halfway there right now. Overall, kind of the charts here, the 1,700. So that's kind of a very key level. So you can see it's been battling back and forth. The lower end of our range is 1,500, so it's not even close to that. But this would be, I was talking about something on the upside, to watch. This would be the key here, one of the keys is the 1700 on Russell. If we can get a break above that, obviously, it's a bullish sign overall. So that's kind of the low down here on the Russell. Let's pull up charts. Same same type of thing. Let me get the tool out. So this is 19, and then 17. You can see it's had a real big problem. 17, we got multiple attempts. We have a few breaks. Attempts, break, break. This is obviously very key level to watch here. The next, I'd say week and a half. I kind of laid that out the previous week. The next 2 weeks are going to be very telling. So, upside, I'd be watching, this, see if Russell can break 17, and then, the SPX would be another one you can look on the downside, right around 3,500. One of the other ones, and I covered this. All right, still got that. Let me clear the drawings. So we talked about this last week, NDX. Let's pull it up. Not a good sign. It's going to tell you. So, the previous two occurrences where the NDX crossed the 200 period on the weekly charts has been very terrible. So, we have back here in 08, and then we got back here in 2001. So these two breaks, and we have broken it. We had to test here once, nothing really, but now we're 3 weeks so far, 2, and then this week right now we're actually lower again below this 200-day moving period for this. So this kind of throwing up a lot of red flags. I mean, the previous 2 times this really, broke through, was huge moves down. That's why I kind of give it, like another week and a half, to see if we get the big whoosh down. There's definitely a lot of risk, a lot of things that could drive that. Geopolitical rates, everything. We also talk a lot about, Europe being in trouble. And we also talked about who's going to buy those bonds, so the Bank of England had to step in to buy treasuries over there. I saw another note in Japan. They've had 0 bids in 3 consecutive days for the 10-year Japanese bonds. So demand is drying up. As far as these currencies, I mean, the UK, they said they're going to stop on Friday, the bond buying, but I don't know, they can always continue that, but I mean, in all honesty, like that is like the currency markets and those huge bond markets, those are like too big, to bail. We hear a lot about 08, too big to fail. Like those are too big to bail. I mean, the markets are massive, so you can't really bail them out. You can try and help them, but like a big bailout, it can't happen without like Turkey level inflation, which I think hit 80-something% year over year. I saw the tape recently. So this is a big one to watch here. So that 200 period is 11,221. We're still we had the drop below pretty much flat, and then we've had a decent down move here. So this is what I'll be watching also on the upside. And just, I mean, this is kind of like a red flag alert. You don't see these type of things cross, what is that, twice in the past 20 years. So definitely a
Josh?
big red flag. Yep.
Do any of the daily Delphian studies look for bear market results?
No,
Okay,
no, I haven't been able to build any kind of systematic one. If anything, it would be, I mean, we could build like situational ones, I think. Where they rarely come off, they'd be like every 2 years or something. But yeah, I haven't been able to build anything that like has a systematic win on the downside. And I think that's a lot of the function of, just since like '09, it's been pretty much up. So,
well, I've got a few that I will share with you, just you and I, and if you feel like they have merit, maybe we can pursue them.
okay, cool. Yeah, I'm definitely up for that.
Okay,
Thanks, Bob.
sure.
Okay, so big flag here. We threw that out last week, so I'd be watching that too. One other thing, I know Dave loves the VIX, so I pulled up the VIX. So, a lot of the, obviously doing a perfect average type move here. I mean, this is like textbook, run into resistance here, pull back, find support, run up. So I rarely see, I mean, I see this a lot with like, stocks and things like that, but I don't know if I've ever seen it this, well laid out for VIX. So that could be, an indication that, we're going higher here. So the average move is 40, 40%, we're at 24%. So in between those two, that'd be like 37 or something like that would be the average. So really, I'd just be watching, see if we get over kind of some key levels here. Like we get over 35, I'd say stuff's starting to hit the fan because a lot of things are pointing that way. If not, then obviously we can get, kind of a at least, sideways kind of slightly up market. But if these things start spiking, and just the next week and a half, I think is critical. Bank earnings come out Friday. At least a couple of them, I think JP Morgan, Morgan Stanley. So this kind of key things to watch here. Just trying to point them out. Let's go into overall here. Economic. So today we had, where is it? Here we go. Inflation reading. So a lot of the time, these have really moved the markets. So today, not so much, kind of in line. Core PPI 7.2, everything was expected, pretty much right in line. The PPMI year over year was a little lower than last month, but still obviously high, and month over month it was a pretty good chunk. So I think the month over month is kind of people want to see these things dropping, but I think these were kind of like the flags, and market's still trying to figure it out. We got Fed minutes at 2 today, and then tomorrow we got some more readings. Where are they at? I thought we had more tomorrow. There we go. Inflation rate core. I don't, me and Joe are, amateur economists, so we don't know all the differences between between all these different readings, but obviously they're important. So, this could be another market mover depending on how they come in. So they've been moving the markets a lot. So, all right, count down to the Fed. Yeah, we've moved even more towards 75. Last week we we're at 66%. Now we're at 84 for a 75-point hike. So going more and more to the right there. I haven't even looked out past, so I'll just pop that up real quick. So this is about a 50. If we do a 75 in November, so I just kind of focus on the next one. So right now, we're still 3 or 4 weeks away from that, kind of baked in. Fed balance sheet, we've actually had some movement here. Not drastic. So September kickoff 8826. So now we're at 60 billion less, right? 8826. Yeah, about 60 something billion less. So we had this spike here, but since this the 14th, it's been coming down. That's a small one, 16. Another that's like 20, and then this one was like pretty much like 40 billion off. So it's kind of funny. I pulled up the year to date. We're pretty much at the same asset level as beginning of the year. Now, big picture or bigger picture, that's 1 year. Still ways off that, and then huge amount. I mean, still barely a movement here. Kind of like here, the beginning innings. And this was a 15% drawdown. I didn't calculate exactly the drawdown now, but probably between 2 and 3%. This was 15 before they had the pivot. So what else?
Josh,
Yeah, I think go ahead.
just while you're on that chart, I've been noticing more financial chat worries, kind of chat about bond market kind of crashing. The Bank of England had the issue that you just mentioned, but if that very graph starts to level off and the Fed kind of like backs off on the roll off of the balance sheet, if that starts to happen, or if that happens, I would start, to me, that it makes more worry on the bond market problems than are being even talked about today. So I think I'd watch that. If that flattens out or reverses in any way, it's like, to me, that signals big problems with the bond market.
Right. Yeah, I agree. Well, I mean, we've been talking for a long time. The bond market's where the it's going to really be the driver of everything here. And there's a lot of cracks. Some liquidity things I've seen pop up. Credit Suisse, huge bank. In the news quite a bit. And then you got Japan and England. So a lot going on there. Just seems like one little catalyst. I don't know if it'll be like the repo rate in 19, just jumping to 12% or something overnight, but seems like something will kind of trigger this. I think at this point, as they're raising rates, it's inevitable, in my opinion. They're gonna break something, and I'm pretty sure it's the bond market that's going to break first. So, thanks, Dave. I'll open up to questions, comments on the market, and I can pull up that previous state aid for you there, Bob. Let's see.
Dave, again, I wanted to make one other comment that you were making on with respect to the NASDAQ. I have one on the SPX, but I'll wait till your partner chimes in with his analysis there first. But on with regards to the NASDAQ and your comment about a couple of weeks will be the tell of the tale there, which I totally agree too, because that's when we get some of the big mega caps reporting earnings in a week and a half. The week and a half to 2.5 weeks is when most of them report. So right. we should know more then. So that was. Yeah, I agree with that call on that. Wait till then to find out. We don't know now, but we'll find out. But to the point that the Qs are, I think, probably the most, when it comes to concentration of fewer stocks moving an index, I think it's the Qs. So again, I think that's when we'll see the bigger move. Whichever way in that same time period, for that very reason, we'll see those few companies reporting, and then we'll know where earnings are. and how that guidance is going to affect future, revisions and valuations or not.
Mhm. Yeah. So Bob, here's the last occurrence, 720. Pretty much same thing, touched the stop loss, came down, bounced, went all the way down to 3. So you had like 2 days there saying this is strong support, and then like went up from there.
So that's helpful.
Yeah. I mean, if it stays below that 3, then all bets are off. But you can see here, below, kind of right on it. Next day should be like a trigger almost. All right. Dave, did you have any other questions?
I was going to wait until we get the chart analysis from Joe on the SPX, because I got one for there, but
Oh,
you
okay.
might even cover it, so I might not have to ask.
No, my time's up here. Oh, you can wait. Go ahead.
That's actually not on I don't have SPX, Dave, so feel free.
Okay, I was just going to say, this is kind of an answer to the question that came up before too. When your state 3 met, target 3 met, happens to be on this chart, this looks like it could be a double bottom, if you will. Look at that. And some people that just look at the charts might say, yeah, well, it's a double bottom and we're right at the bottom. And 2 weeks from now, we'll have a lot of some SPX earnings notions, if you will. But being at the neckline of, this state 3 met is right at the neckline of the double bottom, if it would happen. So the question and the answer the comment I would make to the previous question is, if there's a bounce up and we get a rally after, if we go higher than the neckline, or go better than the phase test or target 3, and all the reasons for the let's say the negative trend are being resolved, then we have a chance to move forward. But and if they're not, then there's just as equal chances that we'll have a downdraft. And to look back, the question was, how many times in the past have we gotten a bounce up from the target 3, or like the neckline and the double bottom? How many times has that gone up? I would say it's gone up the number of times where the problems for the downtrend are at least being addressed or resolved. And if they're not, if they're still open, those are the times I think it'll fail. So to me, I ask myself, well, have all those issues been resolved or not? And if not, then I'm more pessimistic. And if I'm, think, well, yeah, maybe we at least have an answer for them and the market's forward looking, then maybe we have a chance for a bounce. So that's what, I'm always looking for the cause, even if it's, non-existent or hard to find. But I think those are the reasons why the ones that break through, and the ones that fail. If the causes for the set of conditions are reversal, then you get a reversal. But if they're not, you get a continuation. That's my logic behind, what we'll see, or we don't see it about a week and a half. So anyway, that's what I would say. You have to kind of have when you're trying to correlate to the past, are the reasons for the existing, conditions the same as they were in the past when the past, happened? If they aren't, then you can't rely on the past. If they are, then the past is a great indicator. Just saying. All right. Anyway.
Good points, Dave. Appreciate it. Yeah, it's going to pull up the 10-year too. I mean, we're getting right near that 4%. Where is it? Got it somewhere. There it is. Yeah, brought this up quite a bit, but I mean, we're getting up near that kind of 4% where things just fall off a cliff. Rising yields above 5%. Everything's pretty much negative. So we're getting close to there. Next Fed meeting, we could be somewhere in that range, but just want to kind of remind people of that. There's a couple other ones. Oh yeah, saw this one, rent growth for all us Tampa natives here. Urban versus suburban rent growth during the pandemic. So you can see here, this is where Joe, he's kind of in this region, 18% urban versus 14. And guess who's the top? Tampa. We win the rent growth during the pandemic challenge. 43% for urban and suburban rent. That's, during the pandemic. So saw that as just checking out, kind of expected Tampa to be, but it just jumped right out. There's our Tampa. Another kind of interesting one, biggest, asset bubble ever. So this is housing plus stock values over GDP. This shows you over time, we got up to like 90 trillion, but basically I would say this has been kind of like this since we got off the gold standard. But obviously way, pretty crazy. Just saw that it was interesting. And the last one, saw this is like a Bank of America kind of like survey, and just kind of gives you like basically the biggest risk out there that money managers and stuff are concerned about. It was kind of interesting. That's why I just pulled it up. I think it's FMS tail risk, and I'll show you, but it's kind of like what's the biggest worry out there for people? Not necessarily the same things I would have been worried about all the time, but a lot of hard landings. I think they're landing pretty hard overall if you look at Chinese securities. But yeah, so just a couple interesting things I want to throw out there. So, all right, anyone else questions, comments? All right, well, I'll turn it over to Joe. Thank you
All
all.
right, Josh. Good job. I'll grab the screen. Just a couple charts, and then, as you said, I want to start doing some homework on the market pulse, so I'll just throw out a couple odds and ends there. But I plan to work on that over upcoming weeks. Couple of the XLF, or a couple of the ETFs we talked about last week. Got a little bit of movement, but really just one that's really made a significant move. We talked about the 30 level holding in this thing, and it's hanging on by a thread. The financials, as Josh said, we've got some of the bank earnings at the end of the week, so I'm assuming it's going to move one way or the other. Whether we head all the way down to target 3 remains to be seen, but as is the case with a fair number of these state eights, we've still got some time. I mean, on the index side with the NASDAQ, the Russell, and the SPX, we're coming up on the average period of time within a couple days. Got more like 11 in terms of the average time in the state 8 here. 26 occurrences back to 2007. So, and we're banging up against the average move as well. So just something else to keep an eye on, and I would think we'll get a good sense of maybe future direction after the numbers on Friday coming out of the banks. This is one that actually has moved, and since last week, and not a shock. We were talking about this thing, seeing if it could hold the 35 level, which was the 5/8 retracement going back to the COVID lows. Hasn't done that. Been a tough week in this particular XLF. And as I said last week, there are a lot of different components here, but this one certainly has been leaking this week. We talked about the consumer discretionaries. They're leaking as well, coming up against the state 3 target. Already had an average move, so that continues to leak to the downside pretty aggressively. And then the Russell, we've talked about, as Josh was mentioning, trying to hold that 1641 level, which, we're still doing. We'll see what the rest of the week brings. But so not too much with the charts. I did want to just, the market pulse, that Josh talks about all the time. I went back to 2007 because, at the end of the quarter, September 30th, the total bullish states in market pulse was below 10%. It was down to like 881 total bullish states. So I wanted to go back and see how many times, over the course of the database, I started kind of below 15 and then I dropped it to 10. How many times have, 1, 3, 5, and 7 totaled 10% or less? And any guesses how many times, the pie may have gotten below 10% for all bullish states over, what are we talking now, almost 15 years? Any guesses how many times?
8.
Was that 8, Bob? Okay, we have one. Do I hear any other estimates?
I'd say 2%.
Okay. Well,
I'm with Dave on 2.
Okay. If I had to just guess, I would have guessed probably north of 10. It happens to be 6. But thanks for the guesses. And I want to go further, and I am going to do more work, because what I haven't done yet is get a chance to see how much the market and just looking at the S&P, how much the S&P has moved out of these extremes, and I will do that hopefully by next week. But just to review the 6 periods, the first one, again, the database started January 3rd, 2007. We could all guess when the first one was, and that was Lehman, October of 2008. So what's actually Lehman was September of 2008. I went back, and that was September 15th. The total bullish states, the day of the announcement, was 34 and change. Okay, it wasn't until a month later when we basically bottomed out. I think we got down as low as just under 3% in early October, and anywhere from that was extreme. But so basically that event happened in the middle of September. We ran single digits for damn near a month between October 7th and November 3rd of 2008. And then we had another kind of retest for another 10 days or so towards the end of November. And then the markets, started to recover. So that's actually been the biggest period of time where we were so extreme. It was darn near a month and a half of single digits with the bullish states. Second time, not a surprise, but we go out to the market low. I think many of us remember that the major market low coming out of the financial crisis was early March 2009. We had 2 days in March, actually the day of the low, March 9th and March 10th, where we were just below 10. And something else I want to do some homework on is, the speed and magnitude of our moves. Well, so that was March 9th. By the middle of April, the pie on the bullish side was all the way up to 85. And to me, there may be something in that. And clearly, in retrospect, we knew that was, the major market low. But for, the market pulse to go from single digits to 85 in the course of a month is really significant. And ultimately, that was the major market low. So again, more work to be done on just reading into the market pulse. Number 3, and I had to go back and look to see what the heck happened in 2011. Anybody remember what happened in August of 2011? And, I Googled it. It came up right away. Black Monday. Black Monday. What the hell was that? I thought that was October 19th, 1987, which it was. But the August 2011 edition was the Friday night, August 8th, S&P downgraded U.S. debt for the first time. The market a week before had been down a little over 4%. And then on the date of that, and that came out on a Friday. That Monday, the market was down 5.5%. Market Pulse got into the single digits for 5 days, right on that news between the 9th and the 15th of August. It did stay below 15 until the end of August, and then off it went. So that was number 3. Again, I have not had a chance to go out and see, how much of a rally in the S&P. That'll be forthcoming. Number 4, we go out all the way to 2018. So, between 2011 and 2018, the pie was really never under 15. It was only under 15 twice, never in single digits. But then, we get out to the end of the fourth quarter of 2018. Josh talks about this all the time, when the Fed tightened. And that I believe started in October. So in the beginning of October in 2018, the bullish market pulse was in the low 40s, 42-ish. By the end of October, we were down to 12. Didn't get to single digits, but we were down to 12. It wasn't until Christmas Eve, December 24th, where we got down to single digits. And I think we were only single digits for a day or two, with that Fed tightening back in 2018. I don't need the charts for this. I remember the market did bottom that very same day, Christmas Eve, December 24th, 2018. So that was 4. Number 5 was the second longest period of single-digit market pulse. That was, of course, the COVID lows in March of 2020. Solid month of, basically, I think the low was about 8.5. I think we may have just been between 8 and 9. I may have to go back and check that. That sounds like it may even be a little bit high, but I think maybe I'm getting confused. State ones might have gotten down to 3%, but I think the numbers are, bottom line, single digits for better part of a month between March 11th and April 8th in 2020. We took off from there, and then only most recently, the end of the third quarter here, September 30th. I think we had 3 days between September 27th and October 3rd. We were below 10. The last day of the quarter being the absolute low in terms of the market pulse at 8.2. I did go back because, we keep talking about, the June 15, 16, 17 lows, which still are the lows for, some of the indexes at this point. We had a mini retest around July 14th, but I went back. So the market pulse for the June lows didn't get to single digits. We were basically in the 12, 14 range. So, the point of all this is that we are at an extreme. We've had 2 periods where, we've basically stayed in single digits for a month to a month and a half, that being Lehman and then also COVID. Be interesting to see where we are. I mean, Josh has been talking about a couple weeks, Dave for a couple weeks, being really critical here. So, it'll be interesting to see whether the extreme in the market pulse turns out to be, a bit of a forecast as well. So I will follow up with S&P moves. And as I say, I want to do some homework on the intensity of some of these moves from, the mid-50s in market pulse down to, the mid-teen range, and how the markets move 30, 60, and 90 days after that. So, we'll have more on this, but I just wanted to share how important I thought the fact that we're down in these single digits here, in the last couple of weeks, in the market pulse. So happy to discuss if anybody has any questions, but that would be it for me, Josh.
Say, Joe, Dave again. I remember those dates when things happened. I just didn't remember the exact date, number of the date, but I remember the Christmas Eve crash, I'll call it a crash, because it was totally caught me by surprise that day. And then the Standard & Poor's downgrade, I remember that too. And at the time, I remember, well, that's interesting, and that's the cause. But just today, Josh's discussion and our bond market discussions lead me to believe that it was the bond market responding to that S&P downgrade that was the biggest issue for that day. And I wouldn't even have guessed that until we had this discussion today. So cool, and thanks for that. The other comment about we're extreme positions today. Going back to just my previous comment about are the issues today still pending or kind of being resolved? And if the extremes of today don't hold and we go lower, in my opinion, it'll be because all the market participants don't believe the issues are resolved yet, and still will be willing to take prices down on most everything. The leaking that you talked about in all of the indices that you were talking about, each one is leaking lower. To me, that says that's recession risk being priced in across all the markets kind of evenly, if you will. That's the way that feels to me. And not one spot has got more trouble than another necessarily. I think we're seeing the recession effect taking a hold of stock prices on a everybody treated equally kind of basis. In other words, they're all going down a little bit. Anyway, by the way, if you're doing some homework and you're looking to do some research and past, let me know. Maybe I can help you out on some of those, past extremes, because I'm interested in, those reasonings behind those two. So let me know offline and I'll see if I can help, I will.
Okay, and thank you, Dave. And in terms of the cause versus, the market obviously is forward looking. How long does it take? And I agree with you, everything's kind of leaking down and, to some extent that would seem to be pricing in recession. I always remember, and we're going way the hell back now, when Nixon resigned. So that was August of '74. And obviously that was on TV every darn day. The market was under pressure, but it wasn't until December. I'm pretty darn sure it was like very early December of 1974 when the market actually bottomed. I think it bottomed around maybe 560 or something in the Dow, and then off we went. And it's so interesting. The psychology of the market, how long it takes for things to just play through, and that's one I always remember. It took a couple months, and so we'll see. It's part of the fun of trying to connect the dots.
All right, well, good discussion. Anyone else before we close up here? All right, well, thank you all. We'll do it again next week.
Thanks, everybody.